So everybody should be here in the room. More people are still coming. We're getting about 2 or 3 every minute or two. Welcome everyone. All right, I got the right screen up now. Okay, good.
Okay.
All right. So Gene, what I was going to do is I was going to have Steve start off, and then you, and then either me or Jack follow up with the following. And then we've got a couple announcements and stuff at the end. So Steve, do you want to take it away?
Yeah, I think I'm ready.
Okay, great.
So I clicked on share screen, and I think you should see my screen now.
Yes, we do.
Yes, we do.
All right. So first of all, I made a Word document that just to delineate or to say what techniques I want to talk about. There are probably hundreds of techniques at least for exiting. And I'm only going to talk about a few, but here they are. So many years ago, when I first started trading, I tried all kinds of percent exits. And that would be, for example, 1% down, I'd get out, 3% down, get out, 5%, 8%, whatever. And in that realm of percent exits, I also put profit targets and stop losses. And I even tried things like, okay, I'll set a profit target of 3% and a stop loss of 1%. But anyway, I tried various percents for exiting. And I found that if they're too big, if the percentages are too large, then I lose too much before I get out. If they're too small, then it's not enough for the wiggle room to take place. So I did explore it quite a bit. And I found that in some cases, percent exits are really good. They actually keep you in the trade long enough and get you out soon enough in some cases, but certainly not over the longer term of, like, say, 2 or 3 years, or for a wide range of stocks or ETFs. So generally, I eventually said, nah, they work sometimes, but they are not something that's really a great exit strategy. But that is one of the kinds of exit things, is just going by percent. Next general category, I'd say, is moving averages. And for example, I think most people have probably heard about the 820, for example. If the 8 crosses a 20 going down, then sell. And if the 8 crosses a 20 going up, then buy. And here's an example of that sort of thing. This is the, let's see, this is TQQQ. And there are 2 moving averages on the screen. Can everyone see the screen? There's a purple line, a yellow line.
Yep.
Okay, good. So this is what happens. The yellow line is the 8-day moving average. This is a daily chart. Practically everything I trade is daily, and mostly triple ETFs. And this is a good example of that, TQQQ. So what you see here is the 8 is the yellow line, and the 20 is the purple line. And when the 8 crosses the 20, crosses below the 20, you sell. So there you see, if you've done that, you've gone down to there. And when the 8 crosses the 20 going up, like right there, then you buy. So in this particular case, you would have sold right there, shorted, and then you'd get back in right here and go long. And all this time here, from April all the way up until right there in September, mid-September, you'd be in the trade all that time. And you would have gone from about $50 all the way up to 140. So in a case like that, it looks really good. Yes?
Are they simple moving averages? I'm
Yes.
sure. Okay.
Yes, they're all simple moving averages. And most of the experimenting I've done has been with simple moving averages. I did try exponential, and I tried a couple of others, but for the most part, they all kind of work sometimes, and they don't work all the time.
Right.
Like this, for example, in this particular time frame, from about, well, all this year, it would have worked great because you're in this trade a long, long time. Then you get out and you make a nice big profit. But over what I found in my experience has been they will work a long time, and they may even work for several different stocks. But in reality, I found they're not all that great. They keep you in too long. They get you out too early. But it is a possible way to exit. So it's a thing you can certainly try. Let's look at another one here. This is the UDOW chart. And you'd see this one is a little bit more choppy. It got the right thing about getting out. It got in here, that's good, but then it gets out again here and stays in there a while, and then it goes short again. And it gets in and out and in and out and in again. So moving averages have that thing, the comparing the two of them, the 8 and the 20, and I've tried others as well. Like I've tried the 3 and the 5, the 20 and the 50. And so if you use pairs of moving averages, they certainly will work in some cases and over some periods of time. But the downfall of them is that you do get chopped up sometimes. And when the chopping starts, then you lose money at that. Okay. Next general category of moving averages, excuse me, of exits is standard deviation. And Ken actually has one of the best things I've ever seen about standard deviations, that exit, K-exit 2, I think you call it, or something like that. And I'm sure he can talk about that. But on standard deviations, you can look and say, hey, I think I want to exit when the price is 1, 2, 3 standard deviations away from what I actually wanted. And for example, here's UDOW. And if you wanted to look at standard deviations, you can say that it's right there on the TradeStation chart. It's the regression channel. And if you look at the regression channel, when the price gets up near the edge, then you could sell. When it gets near the bottom edge, you could buy. You could sell up there and buy down there. And this sort of a thing, if you've got a lot of patience and you want to stay in it a long time, this can work. Over time, you know, it's not going to work on everything. You'll get chopped up from time to time. But I find that it works pretty well over periods of, anywhere from 3 weeks to 6 months. And this one went on, for example, from April to October. So that's another possible way to do exits. Trend line. This is another one that is just a general way, and a lot of people use this, I think. And they'll draw a trend line on the chart, and then when the price crosses that trend line, they'll decide, okay, well, it's reversed, or it's continuing, or it's not continuing. And you can draw trend lines. There's a lot of subjectiveness to it, but for example, on this chart here, you might start a trend line there and draw it up to there, and it goes up to there, and then you might say, uh-oh, as soon as the price crosses the trend line, then we're going to sell. And you could move the trend line to different places. You could say, if it crosses below there, I'll sell. You could use it up there. So you can put these trend lines anywhere you want to. But you can, I have used them. They work some of the time. You have to be careful though, because when they don't work, you can get in a little trouble with them. So trend lines are a possible way. And basically you just draw a trend line on the chart, and if it goes above or below that, and as the price crosses trend line, you could even combine moving averages and trend line. You could say, oh, when the 8 crosses the trend line that I've drawn on there, then I'm going to buy, or I'm going to sell. So trend lines are just a possible way to exit trades. Now I've made an asterisk out here at this the 1 day. I put that in bold because that's one that I actually do use. These others are things that I wanted to say that they exist, but I don't use them. The trend line, the 1 day trend line, I actually use. That's what I'm using in my current strategy that I trade all the time. I tweak the trades, everybody knows that. And all we're using here to get out of the trade, I wouldn't say all, but basically what we're using is when the 1 day trend is down, then we're going to get out of the trade. And here's an example right here. Right up there. The 1 day trend, what we're looking for is a lower high and a lower low. So between these two bars right here, this is a lower high and this is a lower low. And a 1 day trend, if you follow that, is a pretty good way to exit. Whenever you see a 1 day trend, you can get out. You can always get back in the next day because next day it may be a higher high and a higher low. But that's one I wanted to just highlight because it is something that I actually use. It's in the strategy, my trend strategy. And so that's what's going on. The little yellow markers here are signaling to get out. And that's because the previous two bars, there was a lower high and a lower low. And that's all there is to it. Okay, the next strategy for exiting a trade, I call volatility. And I put this math in here just so you can see it. I'm pretty sure this is going to be recorded. So with this, this is easy language code right here. And to calculate the volatility that'll get you out of a trade, a good exit strategy, I think, is we calculate the bar size, which is high minus low. That's pretty straightforward. Then we find a midline of whatever of each bar. And the midline is high plus low over 2. That's basically, it finds the middle of the bar. And then we calculate this thing called VOLTI. I couldn't use volatility. That's a reserved word in TradeStation in easy language. So I called it VOLTI. But anyway, it's bar size divided by the midline. And that's basically finding out what's the ratio of how big this bar is to where we are in the middle of the bar. And whatever that is, then I take the average of it over 5 bars. And whatever that average is, I also find the average over 50 bars. And I should change this here because actually right now I've been experimenting a little bit and I found that 30 is better than 50. So I'm using 30 right now. So I take the 5 bar volatility and I compare it to the 30 bar volatility, average volatility. And if the 5, here's the thing right here. If the 5 is greater than the 30, then exit. And if the 5 is less than the 30, we stay in the trade. And this is another one that has an asterisk. I actually use this on my chart over here. This is a plot of that volatility. And as you can see, when the bars are really big, right in through here, or right here, these bars are bigger than average. And as long as over here too, these bars, bigger than average. So if you have big bars, generally, that's what the red amounts to here. This red over here. And when I see the big red bars, or the big bars, whether they're red or not, when I see large bars compared to the last 30 days, that signals me, get out. Do not be in this, be trading this. And this is just for my style of trading. I trade ETFs long. And for that style of trading, when there is a when the bars are larger than average, which is here, 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 and out here, when that takes place, I do not trade. I just get out of it. I'm done. For example, right here, I got out of this trade up here and have not been trading since all of October. Looks like now they're coming back green again. So it's becoming time again to trade again. And sure enough, we have here a buy signal for Monday. So I've already tweeted this. Monday, I'm going to be buying SPXL, and I'm also going to be buying NAO. It has the same thing going on. We were red over here. The volatility was too high, so we didn't trade. And then we got the trade right here. So both NAO and SPXL, I'll be going long on Monday. And the final thing, last way I can tell to exit, is news. Now, most of you know I don't even have a television set, so I do not watch mainstream news every night and listen to what they have to say and their opinions and all that stuff. But what I do keep aware of is I look at Twitter from time to time, and I get news that people send me. You know, I get the general conversations that are going on in the world. And if generally mainstream media is saying that the market is going up, they seldom are, but if they say the markets are going up, that's a good sign for me to exit. Because whatever the mainstream media says, they're wrong. And they're almost always wrong. So I really, if I hear in the media that they think the markets are doom and gloom, everything's bad, the economy's terrible, if I hear that, I'm a bull. I'm ready to go. I'm buying. But if I hear in mainstream media that they think the markets are good, we're going to beat all records and Wall Street's happy, then I get a little trepidatious about that, a little bit anxious, because whatever they say is almost always wrong. And that's what I have to say about all the basic general kinds of exits. And if there are any questions, I'll answer questions. Okay.
Thanks, Steve. Any other questions by anybody? Hopefully people can turn on their mics. I think they should be able to turn on their mics at their own will.
Okay, I'll stop the sharing and we'll go to next.
All righty. All right, Jim, you wanna pick up where Steve left off there?
I will. And let me see now. I just want to share my screen. You see that?
Oh yeah.
Okay, let me decrease the resolution because typically that makes it better for you guys. See that?
Yeah, I can see a bunch of screens, but they're all too small to read.
Yeah, that'll get better. Okay. How's that? Okay, if
Okay by me.
Can you guys see that now? Is it better or worse?
That's
Good for
better.
me. Okay, better.
Okay. Let me just, if you will, just let me just type a couple of numbers in here. We're just finishing a table. Just 3 more, we're done. Let me just see what I did here. Oh. Okay. Sorry about that. So taking a different tact. Okay, I think you can hear me better. Taking a different tact.
Yeah, better, much better.
Yeah, my ear microphone up. Okay, then what Steve just did. I'm a strategy trader, TradeStation strategy trader, and let me just see what happened here. And that gives me an opportunity to do things that other people can't do. And for me, I need to be a strategy trader because I'm a very bad discretionary trader. But it's worked out well for me. So what happens when you're a strategy trader is that you can write a computer program that defines how your strategy is going to buy and sell. And you can attach that to a chart, and instantaneously you can see the whole history of what it did and what it's doing now. So I have a strategy that's called it's a dip trading strategy, and I'm going to do it on the same chart that Steve used in the beginning, which is the TQQQ. But in my case, I'm going to be using 15-minute bars instead of daily bars. So for example, that would be the first chart over here on the left. If I make that larger, you can see along the way that like the blue lines are where it bought and where it sold, and it's blue if it's a profit. And if I had a loss where I bought and where I sold, then it will come as a yellow line. So along the way, it buys and sells. And during the day, I go out and about. You know, if I'm home, I check it if I hear the chime go off. But it's nice because I don't have to sit in front of my screen and trade 15-minute bars. And then what I can do is I can always, at any time I can get the picture of what the profit curve is that's associated with this trading scheme. So if I click this over here and to get off the numbers, we'll look at a performance graph. So the original strategy is a really good one. You know, now all these charts will go back 1 year, and every trade will be $100,000 a bet on every trade, and that will not change. It's a flat $100,000 a trade. So in this case, over the course of a year, and this is just a profit curve, it comes into about a little over 130,000. So this was 130% profit in a year over the past year for this particular trading strategy. And I like it because it's a low drawdown strategy. You know, it has a little bit of a drawdown here. It's pretty flat. It's skated through the big downturn, which was really due in large part to Steve Alexander coming up with his volatility criterion. So when we get volatility that exceeds a certain level, if you will, the strategy will stop trading, which is really nice. So that's not a stop in itself, but it prevents losses in a down market because it doesn't let the strategy trade there. So we came out of this and we boomed up as we typically would, and we skated for quite a long time. And then we had a nice uptrend and we skated in the most recent downturn, and now we're trading again. So we're kind of even up in here. So this is the original strategy, the dip strategy on TQQQ. So I'm not going to talk about how it buys and the intricacies of that. We're just going to look at exits today. So skipping from this chart, and I'll just minimize this again. So let's take a look at the summary as we just go through it, and we'll talk about these numbers a little bit as we get down here. So this dip strategy has got 4 exits, and actually it has actually the main exit. So if you want to say number 5, which we're not going to look at because that's doesn't have anything to do with the stop. Say exit at next day's open. Okay. So
what's the criteria for exiting at the next day's open then too? Oh, you're going to go through those, right?
Yeah, well,
okay.
Let's just look at this one right now. Okay, no matter where I buy, if I get to the end of the day and I have not yet been stopped out by any one of these 4, then we're going to exit at the next day's open. And I have a way of defining a custom session that puts a 1-minute bar at the end of the well, actually it doesn't even need it, but it tries to make a purchase, it tries to make a sale at the end of the day, and it can't do it because the market's closed, and it rolls over, and what it does is it just sells at the next day's open. So this strategy will never hold more than a trade more than 1 day. But of course, it could take a lot of trades. So it could be in the market to some extent or another at many days during the year. But whenever I take a trade today, if I don't get stopped out earlier, I'm going to sell that at the open the next day. So that's really the fundamental behavior of the strategy. So let's take a look at what I would call the stops that are in the strategy. So first of all, it has a stop loss. So a stop loss is one of them that Steve mentioned. It's a percent stop loss. So typically a strategy like this might be, maybe it's a 2 or 3% stop. So if I lose from my position 2 or 3%, whatever it is, from where I purchased, then it sells immediately, and it doesn't wait for the bar to close. It just sells immediately if I lose that much money. Now, so we know what that's like. And then a profit target, we know what that is like that too. So I can define a profit target, and then I can optimize the profit target to some number. And let's say, for example, the profit target might be 5%. So if it goes up and I'm ahead 5% on my position, it will sell that position instantly right there as soon as I hit my 5%, or whatever it is. Then I have something that's called a qualified red bar. And these are some, what I would call secondary stops. I would say that the stop loss and the profit target are primary exits. You know, I mean, typically, you know, we like to look at trading strategies having a certain risk, a certain reward or risk ratio. So that would be like the profit target to the stop loss. So these are probably the most used exits, you know, in the market. I mean, you know, it's pretty simple. You have a loss or you have a profit. Then I have a qualified red bar. So I know that, like, even coming from Ichimoku theory, or what the Japanese used to do many years ago, I mean, if you read some of that, they'll say, if a red bar comes up, sell it. Now, a red bar is something you'll see only if you plot using candlesticks. So once again, if we want to see how that red bar works, if I just make that larger, get rid of this thing. See, here's red bars right in here. And if I just highlight that area, for example. So we hit a qualified red bar right in here, and we sold immediately upon the next, when that bar closed, we sold the position. So
What makes it a qualified red bar?
So what is it? Yeah, what is it? What qualifies it? Well, there's two parameters that I use to classify a red bar, and that is its range, or the size of the bar, and to what percent it's filled. Now I could just dial those numbers in, but what I do is I use them as input parameters in the strategy, and I optimize on them. So we don't need to decide exactly what the numbers are right now, but that's how I define it. How big that bar is, and to what percent it's filled. Like, for example, you might have a small bar that's a doji, and this thing is neither one way or the other. It's red, but it's too small, and it's not filled very much, you know, very little. So I don't want to exit on this kind of a bar, but I want to let the program tell me what the optimal ratios are, you know, like how much it's filled and how big it has to be. You know, these things would be qualified red bars for sure, because this one isn't, it's even smaller. So I think hopefully that describes what that is.
Got it.
Okay, good. And then, okay, now I have what I call a coded trailing stop. Now there's a trailing stop that's embedded in TradeStation itself. It's called a percent trailing stop. And sometimes I use that. And but sometimes I also use a coded trailing stop. So what I do is the stop statement per se that's in TradeStation in the easy language is a very versatile statement, because you can configure it to do all sorts of things. You could make a stop statement into a break-even stop, simply saying that you will exit if you're up and then you come back down to where you bought, or you can exit at the bottom of the current bar, or the bar before it, or the bar before that, or any number of bars before that, or any other combination of things. So right now I have a coded trailing stop, and the way this one works, it's interesting because it says that if I get 3 green bars in a row, then I'll enforce the coded trailing stop, thinking that after that this thing is going to run, and then I want to be able to stop out. That's, you know, when the market begins to back off, but only after I get 3 green bars, because to me that's the signal that the market might keep going. So that was just my concept. That was just the day I did it. And then of course, those are the 4. And then of course, no matter what happens, if none of these happen, we're going to exit if the next day's open. Okay, so the first thing I did was, I says, you know, and I'd never done this before. And actually I was really surprised by the results myself as a result of Ken asking me if I want to make a presentation today. So I decided to take these different stops that I have and start turning them off one at a time to see what the effect would be on the performance. So the first thing I did was, okay, let's take this. So the original strategy over the course of a year, you could see the number right here. It's about $131,900. Now, when people talk about performance, a lot of people think how much money you're making. And of course, that's part of it. But to me, that's not the important thing. I want to be able to make money without taking a lot of risk. So I'm constantly striving to design strategies that have small drawdown. And to me, the most important parameter in the performance of a trading strategy is the ratio of the profit divided by the maximum drawdown. Now, I can define this in a little bit different ways in reality, but let's just call it net profit divided by maximum drawdown. So the original strategy is really quite good, 12. It's a 12-to-1 reward to risk strategy. If I take the stop loss off, let's take a look at what happens in here. First of all, this is the curve right here. Okay, if I take the stop loss out, I actually, for a time, even achieved a higher high. I even got more profit. It was up to about 140 until it dropped down to roughly the same number. So you see, it was 131. So the original strategy made 131.9, and if I took the stop loss out, it was 131.2. Well, it looked like it didn't make any difference. But in reality, yeah, the performance, the profit didn't make any difference. But look at the ratio. So that means that the drawdown had to go up a lot. And if I look at this curve over here, you see, we did have a big pullback. And if I go back to the original strategy, you see, we don't have that pullback. We just skated because that stop loss was active and prevented me from taking this kind of a drawdown. And over here, I think this is a smaller pullback than this one. So that's what the stops tend to do. They tend to take the drawdown out. And hopefully they don't take out too much profit with it. In this case, it didn't take out any, because we were 131.2 versus 131.9. But now we have a lot less profit per unit of risk than we had with the original strategy. Okay, so then I said, okay, well, I'll put the stop loss back in. Let's take the profit target out and see what happens there. So there, we actually made more money, 144,000, and we didn't change this much. Now I was surprised because I think profit targets are really important in short-term trading strategies. But you see, from 12 to 11.1, you know, that's fairly small. This one over here, see the 144,000. So this would be preferable than the original strategy because I'm making more money and I didn't really change my reward to risk very much. Now the trailing stop doesn't turn out that it hits that often. And so it didn't have much of an effect on profit, and it didn't have much of an effect on the ratio. So I could probably just take this thing right out of the strategy and it wouldn't make any difference. Now the qualified red bar, now we're getting into one that's active a lot. And let me see, this is like 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. Okay, that's this one over here. Let's take a look at this strategy over here. So you see there's no red bar exits in here. So the only way we exit is a trail. And like we said, I already know that one makes very little difference. And we either exit by a stop loss or we exit on a profit target. So with all intents and purposes, you either go up to your profit target or you get stopped out at a stop loss, but nothing in between. That red bar exit is no longer active. This one over here is a stop loss. Okay. Okay, so this is what we have, but already we see that even though the no red bar made a really big difference in the profit from 131 to 179, it dropped the reward to risk down by a factor of 2. Now, personally, I would never trade that strategy if it's down this low. If I had one here, I would never give up this one to get that one, because the most important thing to me is that ratio. So what happened here? I think in this case, I think it's probably from this peak down to here. And that probably gave you the increased drawdown that resulted in the 6.2. Okay, so now let's just do a little more of this. So now I'll take out the red bar and I'll take out the trailing stop. And the only thing I'll be left with is the profit target and the stop loss. Well, that one, again, because I took that stop loss, I took that red bar exit out. Okay, no trailing stop and no red bar, 189,000. So we went up a little bit and we just got a little bit better on that ratio, but this is still too low. I would never trade this strategy version compared to the original. And I said, okay, so one thing that I haven't been doing is that when I take these out, I should go back and re-optimize the strategy for the stop loss and the profit target. So if I keep everything the same, no trailing stop and no red bar exit, and just go back and re-optimize the stop loss and the profit target, bam, I'm all the way up to 230. This is really a lot higher than these other ones. And I improved my reward to risk ratio. But it's still rather low. I still would not, let's see if I can show you what that looks like. 1, 2, 3, 4. Okay, yeah, that'd be this one right here. Okay, so this is the equity curve of the strategy that does not have a trailing stop and a red bar exit. It only has a stop loss and a trailing stop. And it's pretty much similar to the ones before, but before, like for example, over here, let me make this smaller. So I can see more of this. Okay, so the original strategy looked like this, and we skate through here. And this one with no trailing stop and no red bar exit is like this. So the original strategy was skating, we're doing really well in that period here. And we get all the way up to 240. So I like this curve. I would be inclined to trade it, except that it has the 7.7. So what's giving me the 7.7 is probably this drawdown in here. You know, one might also say, well, you know, if I only get a bad drawdown once, is it really something that I should pay attention to? And I think that's up to the person who's developing the strategy. But I myself would let that go, and I would say, yeah, I think that's a pretty good strategy. I would trade that. Now, the last thing I would do is here I have a red bar exit in here. I do not have a trailing stop, and I do not have a profit target. That's what this last one was. Well, I dropped my profit a little bit to 206, which was still a lot better than I had in the beginning. But it turns out that having that red bar exit in there and having that stop loss in there really trims my drawdown. So if I have 206, instead of having 230 with the 600 and 230, 600 with the 7.7, I now have a little bit less profit, but I have like double the reward to risk. Okay, and that last one would be this strategy right here. So here we're up to the 206, and I don't have these big, this is the big drawdown right in here, and you don't see any big drawdowns in here. So I'm willing to have all sorts of exits in my programs if I can just trim that loss, just try and maximize this number. This is a very, very good strategy at 14.7. So the conclusion I'm making here is that these stops are very important. Okay, I have them in here. I don't have the profit target, and I don't have the one that was inconsequential, but I have the stop loss and the red bar exit, and that helps me reduce that drawdown.
Very nice.
That's the conclusion of what I'm trying to present today. Now, just before I leave you, you know, I'm really glad Ken asked me to present today, because I started looking at this, and this is probably the simple and most easiest example I have to demonstrate what I've been presenting here. Now, I have another strategy. It was one that I developed over 2 years ago. It's very complex. It uses Ichimoku theory, and it uses the concept of what I call an Oliver Velez bull elephant bar, and it has several exits. It can also skate, or it can also scale in. And this strategy can scale in like even up to 2 more times after the original purchase. So this is what the strategy looks like. Let me just let me just change that one thing in here. Okay, so this is the strategy. And this is after I went through and did an analysis like I just demonstrated here and wound up making some modifications to it along the line of what I've done here. I'm not saying it came out to be the same. But look at this, you know, there's almost no drawdown in here. These are the kind of strategies I like. And it's a really high producing strategy because for a $100,000, you know, a trade, of course, it's not an apples to apples comparison because sometimes you're trading more than 100,000 because you're scaling in. But this makes like 400% in a year, a little over that. Now, the one thing that like Steve Alexander does all the time, I think, and now I'm doing, is that you can compound profits. Now, this equity curve does not represent profits being compounded. Profits being compounded means if, you know, like if I start trading the strategy and I bet 100,000 and the first trade I made $5,000, then the next trade I would bet 105, you know, and then if I lost 3,000, the next trade I'd bet 102. You know, that's compounding profits. So if I turn compounding on, okay, this is a 400% winner. If I take, if I put compounding back in, by just changing compound onto a 1, this thing makes about 2,500% in a year by just compounding the profits. And I wanted to point this out because the reason this is true for a strategy like this is because, number one, it doesn't have any drawdowns. So you're almost always compounding up. So, you know, near the right end of the chart, you know, if your strategy takes a relatively significant dip on a compounded curve, it's going to be a big dip because you really loaded up all your shares over here, but it doesn't happen. And the second thing is that this strategy, 45% were winners, but the ratio of the average winner to the average loser was 4. And that's the first time I've ever seen anything that big. So you can imagine if you're winning half the time, but every time you win, you make $4, and every time you lose $1, you're going to have a really winning strategy. But the other thing too is that in 1 year, it made 508 trades. So the other important component of compounding is if your strategy trades a lot. So if your strategy trades a lot and it doesn't have much of a drawdown, you're going to have a huge compounded winner, which is why we get 2.4 million or almost 2.5 million as opposed to 400,000. So I just wanted to point out the concept of compounding and how that plays in to low drawdowns. You know, that they go together to produce really magnificent strategies, but you've got to knock that drawdown down. Otherwise, you know, when you're compounding and you could take big losses, if you take them on the right-hand side of the curve, they get to be really, really big losses. So anyway, this is the end of the presentation. So I wanted to show you how these stops are important to reducing drawdown. Now, the other thing too, there's something even far more important about the smooth equity curve as opposed to just these numbers. It's not just these numbers. If I have a strategy that I know is taking low drawdown, okay, I can sleep at night. I don't have to worry that I'm going to get a big loss the next day. I mean, I could, you know, you never can tell what's going to happen, but based on the strategy, it's unlikely. And that allows me to keep trading that strategy and keep making money. But if I have an erratic equity curve compared to the ones I've shown you, I'm probably going to stop trading the strategy and I'm going to scrum around for a while. And the next thing you know, I'll look at that strategy again and it rebounded and it's a big winner, but I wasn't there. And that just plays into more chaos in your head. So having high risk, low drawdown strategies are the most important thing for being a successful trader because it gets you out of that zone where things really get crazy and your emotions take over. So you can get more. Now, I'm trying to get emotionless trading by being a strategy trader in the first place. But frankly, when you have a lot of your hard-earned money on the line and your right-hand side of the chart, you know, you're still at risk. But at least I can try and minimize all that goes along with it by trying to devise these kinds of strategies. So that's the other conclusions. That's why it's even more important to have high profit, low drawdown strategies. So
Very nice, Jim.
Okay.
Very nice.
Yeah, Jim,
Yes.
I have a question for you. This is Jack. Congratulations. It looks like you got a winner in your hands. A couple of questions. I'm looking at the less than 50% win ratio, which is kind of hard to trade unless you really have a belief in your system. And obviously you do, which is fantastic. It looks like the strategy is taking losers early and letting the winners run.
Exactly.
Right,
Exactly.
okay. So can you elaborate a little bit on the entry strategy? I'm just curious.
Okay, the entry strategy. We'll just take a look at, let me get back to that workspace here. Where did I put that? Not there, put it over there. Okay. Yeah, so the entry strategy says if there's a dip in a moving average. Okay, now which moving average? It's an optimized number, just like everything else. But you can see that in some places there was a dip and it took a position. Over here, I'm not too sure why that worked, but basically what I'm saying is a certain moving average. Oh, I know why. You might not see it in the chart, but the moving average I'm working on just took a dip, and that moving average is not plotted on the screen. Okay.
Mm-hmm.
So it's a dip in a certain moving average, where the dip really is that the price now is larger than the price was a bar ago, and the price a bar ago is lower than the price was the bar before that. That's a dip. It's just a V. Okay. And when it hits a V on that moving average, whatever moving average was optimized, then it will take a purchase. That's how it buys. It's a very simple purchase. And see, and a lot of the strategies are like that. They're very simple concepts for purchasing, but all of the work is in trade management, and trade management is in the definition and the setting the values of these stops that I just presented. That's where the work is. It's trade management, simple entry, and then trade management after that.
Okay, I actually have a couple of entry strategies that you might be able to improve your entries with.
Okay.
If you're interested, we can take it offline.
Okay.
All right.
Okay.
All right. Very good.
Okay,
Applause, everyone. I got to hear some applause.
Excellent, excellent job, Jim. Thank you.
Yeah.
I love seeing success stories and proven by numbers.
Kudos.
Fantastic.
You got kudos all the way around, Jim.
Okay, great.
You
Well,
haven't
I
looked at the chat
appreciate
box.
that from everybody, guys. Thank you very much.
All right. Very, very good. The original, this came from original presentation I did in 2015. It's 5 years later, and so I've updated it a little bit for the current situation and what I've learned over the years. So the question is usually, do you exit to the left, exit to the right? The essence of trading, the whole key to trading is knowing when to exit. Most of us have been hung out to dry a couple of times if we don't put in the entry and the exits at the same time. I have learned that discipline through the years. With Jim and Steve, we all have some way when we are entering a trade, like Jim was showing in those charts. He knows exactly how he's going to exit. Every time he enters a trade, he knows exactly how he's going to exit. That's the key, I think, to successful trading. Exit techniques, we've already mentioned the profit target. There's one that was called years ago, it was called a purple crayon, which is basically an emergency exit. I'm going to show some of that in this presentation. There's a time exit, there's a percent trailing stop, and there is an indicator-based exit and an exit envelope, which is what I like to try to use most of the time. With Jim's, I would actually like to see some way to articulate his exit envelope just to get a visualization. I'm a visual kind of guy. I like to see charts. I'll show you what I'm looking for, what I like to see at near the end of this. So traditional exits, most brokers can give you, like we were saying, the percent exit or the percent dollars or dollars above some entry. It's used just simple stop loss exits. Then you have these are typical, right? All these are typical. We've gone through all these already. So I won't belabor that. I have a strategy. It's called the Holy Grail, and the Holy Grail scales in and scales out. It's the only strategy I've ever found that works in any stock, any time frame, with any equity, as long as the equity doesn't go to zero value. If it goes to zero value, it doesn't work. But if it just goes skating sideways, it always makes profit. So the idea is every time it pulls back a certain amount. So here you see it's trading gold. It's on 60-minute bars. It buys, and then it turns around. It's got a profit target, and it sells. It waits till it comes back down to the next buy here, and then it goes and it sells. It just does that all the time. It just keeps on sucking money out of the market, and I really like that idea. Here it bought in near this, after it sold, it also bought in again, and then it sold out here. So it can hold multiple positions. And then what I did is I drew for this particular trade sequence, I drew what we called a purple crayon line. That this was my exit. If it goes below this, I wanted to see. I was expecting gold to just keep on going up to the right, and since it didn't, I have one of my trading strategies on TradeStation is an emergency exit, which just follows the line. If it stays above the line, it stays out of the trade, but as soon as it touches this, it exits right away. So that was kind of a nice little realized profit on that trade. Another one is the case stochastic. There's several different versions. This particular version was what I used originally. It tries to minimize the risk, like what Jim was talking about. He wanted to minimize the risk to a maximum reward. That's exactly what I strive for as well. And here's the risk. You can see this little tiny thing here. That was the total risk. So when you entered the trade, I basically put a stop just below the recent low. And that was my total risk on the trade. And then you exit when the stochastic turns over the top. In my case, it turns from a green to a red. So then you wait then again for the next time. It comes back down to get below the buy signal. Excuse me, I had to get a drink of water. And you do the same thing again. It shows here's the little risk, and then here's your reward. Here's your profit target. And so I could do this all day long. This is my kind of trading. This is my swing trades. I really like these. And you can actually get, with this kind of a trading, you can actually get better than the buy and hold. And of course, like what Jim says, your drawdown is vastly improved. What I use in my IRA, I've been doing this for probably about 10 years now. I enter using the case stochastic, and you can find this on my website, ken.excessprofits. Go down and look at TradeStation code, and you'll see you can download the code yourself and get the same stochastic. Let's see. So this basically defines it. My good trading exit is when I actually it turns red. So the case stochastic has to turn red, and it has to close below the adaptive moving average. I'll show this graphically in a second, but this just puts it out in verbal, in text, so that people can go back and look at the trading rules. But this is an implementation of it. So you're entering the trade. You're waiting for it to drop below the adaptive moving average. And then as soon as it closes below the adaptive moving average, this little bar here says, okay, the next bar that goes below that, you're going to exit. And that's exactly what it did. So it exited right here. Of course, then it came back in and it entered a trade again, because the market just turned around. It went up again, and it did the same thing. This little tick below the adaptive moving average enabled the next bar to be the exit. And then it just completely repeats over and over and over again. I also carry an emergency exit, which is just below the recent lows. So this would be a low here, and I have an emergency exit trend line that's below that. So my goal is, like Jim, is to minimize my risk and maximize my reward. I'm going to have to use that, Jim, and take a look at see what my reward to risk ratio is on all these things. I haven't done it in a while, so I'll have to take a look at it. So one of the things I like to do is try to create an exit envelope. It's one thing to articulate it. And this is basically the verbiage of all of the different ways that I have looked at creating an exit envelope. But to me, you can read through these things. I'll let you read through them later. You can go online. The presentation's already on Ken.Excess Profits, and you can take a look at these. I'm going to show this graphically here in the next slide. So here's your entry. You're entering a trade when it breaks out. This is a breakout trade. So you're going to enter here, and immediately what I end up doing is if I see this thing all of a sudden just jump up, I have a sell limit. I basically have a target, a very quick target. If it gets up into this range real quick, I just take my money and run. I don't worry about it. And so that lasts a certain period of time. This is a day trading and is 1 minute bars. So if it gets up there within 15, 20 minutes, I will take the money and run. And then I have another, which is a stop here. So here's my stop exit, which just follows it up, and it's based on support, right? So if it drops below support, you see this pulls back and then it comes back up. Well, that support. That's also called Larry Williams circle bar, is another indicator that he uses if you read his book, Long-Term Secrets to Short-Term Trading. So it's the same thing. Investools, everybody shows support and resistance. It's the same kind of stuff. There is also a trend. So I've created an indicator. There's a thing called a Gann fan, and it's actually a straight line. So you'd actually have a straight line. So I modified it, call it Ken's Gann, and it actually does the same kind of thing as a Gann fan does, and it basically follows up right underneath the trend. So it automatically computes what is a trend line, and you can see that here. It basically just follows on up right below it, and that's another exit that I have. So these things are all available, like I said, at Ken.Excess Profits, and then go look at the code, the TradeStation code, and you can pick these off of there. It's for your own entertainment and use, if it would help you. So I have this profit target that on options, it's extremely useful. With options, the option price is only, here is like about 25 cents, right? So it's a 25-cent option, it's $25 per contract. But what happens is that if I see a 10 times profit, I take it. And sometimes you get one of these Fed announcements and it comes by and it just nails it. And so what do you do when you get something like that? You dance around and you just holler whoopee and you enjoy life. That's the kind of stuff that I like to see. And then of course you've got all the other exits along the way. But the profit target, the super high profit target in a short period of time, especially if you know there's some sort of announcement that's coming out where the market gets extremely volatile, that's kind of nice to see. So here are some upcoming trades. So invariably, one of the things that we want to try to do at these meetings is to say, well, what should you look at on Monday? And I just tried to show, if you go to Excess Profits, go to the group calendar, one thing you'll notice is that the 10-9 was the go away in May re-entry. Also on 10-26 coming up is a cat trade. I'll show you these things on the next slide here. So if you go to the group calendar on Excess Profits, you can see this is the go away in May coming back on the 9th. So you want to, this thing has, I'll show you the results, the equity curve here. You basically come back into the market. This is a long-term trading strategy. It's almost like for people that are doing investing, long-term investing, they want to just basically just say, okay, I want to get in the market. I'm only willing to do 2 trades a year, one to get in, one to get out. And that's the go away in May strategy. And then there's another one, which Jake Bernstein. So if you click on this, on the buy cat sell in November, you click on that and you'll see the complete description of Jake Bernstein's seasonal trade for cat. And he says it's about an 80% probability of a win. And you can go watch the YouTube. So use the group calendar to help you enhance your trading and provide additional ideas. There's a probability associated with it. It's not guaranteed. And you can actually see, I'll show you the slides here. This is the go away in May equity curve, P&L, based on $100,000. And this is indeed compounded over this period of time. So 25 years ago, you take $100,000 and you'd be up to not quite $500,000. And you can see that the equity curve did drop a couple of times. There was this one year that it did drop a little bit, and not this past year, but the previous year, it dropped a little bit too. So, but these things are basically being in the market. This is 25 years back test, and it's being in the market pretty much 50% of the time, right? Then you can look at the seasonal cat trade. It's only 10 days per year. So think about that, 10 days per year. That's the only time you're in the market. This is the P&L for 25 years with $100K initial investment. And the previous one was $500,000. This is also $500,000. And you can see that there were a couple of little dips. It doesn't always work. You know, you may have a little bit of a loss once in a while. These are 2 years in a row of 2 losses. But on the whole, you've made $500,000 in 25 years being in the market only 10 days a year. I should get applause for that one. All right, I'll go on. Conclusion, when entering a trade, be sure you have all your exits covered, and an exit envelope is what my preference is, so that I know all the conditions. There's no conditions that escape me that show that it is, I don't know what's going to happen. If the market does this or market does that, I have it all specified ahead of time. There's no questions in my mind. So you got to know when to fold them. And here's some references for future reading. So that is all that I had. Any questions, comments, suggestions? And I will, oh, somebody asked, what is the cat trade? Cat is Caterpillar. And if you go to the Excess Profits website and click on the calendar, you'll see the details on the cat trade, where it came from, Jake Bernstein, and all that kind of stuff. So just use the Excess Profits website. And okay, all right. So unless there's any other questions, comments, I will turn it over to buy and hold NASDAQ. So Julie asks if there's any comparisons to buy and hold NASDAQ and tech with these such strategies. The NASDAQ is probably not a good one. If you hold it over a long period of time, you will have seen an 80% drop in your net equity. And like Jim said in the previous presentation, you really don't want to see that kind of a drawdown in a buy and hold. So what we are really good at in this group is trading, getting in and getting out and minimizing the drawdown. That's the whole claim to fame of this group. And any other questions? Gary, that says $5 million. I thought it was $500,000. I'll have to take a look at that again. All right, any others? Okay, I don't see any others. I don't hear any other comments, questions. I will pass it off to Jack. Are you there, Jack?
I am right here.
Excellent. So
So,
you want to take it?
yep. Hold on one second. All right. Can you see my,
You have to see your whole screen.
you can see my whole screen. Okay, good. So I'm going to talk about some exit strategies that I've collected over the years. I studied with Chuck LeBeau, and his nickname was Mr. Exit. He actually has written the definitive book on exit strategies. So I've learned a few tricks from him and a few of my own. So I'm going to talk about that. All right. Now, first of all, it's an interactive presentation. Please unmute your mic and ask questions if you have any. If you go to the bathroom, please turn your mic off. I've done that before. So again, information is deemed unreliable. Use it at your own risk. But these have been in use for quite some time, probably over 20 years. So there is, as former speakers or previous speakers have mentioned, there's always a pull and push going on with exit strategies. Okay, you know, we've said the stop strategies suffer from whipsaws. Sideways markets are horrible for stops. And these strategies are always a compromise between protecting your profit and staying in the trade for longer. Those are two opposing things that are pulling on you. One, you know, are we going down? Do I need to take my profit and exit? Or is this just this minor pullback, so I should stay in the trade for bigger profits? On strong trends, you know, the pullbacks are more likely. On trends that are not so strong, maybe better to exit and lock your profit. And how do you know between the two? And that's always been a bit of a battle. So as I mentioned, those whipsaws, especially in sideways markets, is what kills you with stop strategies. But the cure for whipsaws is actually re-entry. And it's one of the things I really liked about Jim's presentation, because although I prefer win ratios around 70% or more, just makes it psychologically easier to trade, you know, at least for me. But Jim actually took a 48% win ratio strategy and made it a really nice, successful strategy by re-entering. Okay, so he's taking his losses early, but is re-entering as things, for example, on a good, strong trend up move, he may be you know, exiting or maybe even taking a loss on a pullback, but he's not afraid to re-enter again and ride the rest of the move. So that's a perfect example of how you can get around whipsaws. And one thing, you know, I refer to, many of the old timers know about the turtle entry strategy. For those of you who are not familiar, turtle entry strategy is one of the earliest, if I think in the 60s, if I'm not mistaken, maybe 70s, was a trading strategy for commodities, for futures, where a trader said, I can teach trading to anyone. And I think he took like 20 or 30 people who've never traded before, and he showed a strategy. And it had a very low winning ratio. I cannot remember, but it uses a 20-day breakout. So anytime you get a 20-day breakout, you just, you know, stack, and eventually, you know, you'll be making money. But it had a very low winning ratio, but it made money. So, so what I was talking about is, as I said, every exit strategy has whipsaws. We cannot avoid them. But just like I was talking about turtles, you will see the 20 bar breakouts. These are all entries. And if you get stopped out, whatever your stop strategy, exit strategy is, if you ever get stopped out, this would give you re-entry. I'm not suggesting you use this, but some kind of a re-entry strategy would be really good. Okay, that's the only way I know of that you can really fight against getting whipsawed. Any questions before I go into some specific stop strategies? All right. Percentage stop, much better traders before me talked about it. You can take a percentage depending on your time frame. On the daily bars, a lot of commonly used stops are 8%, 10%, or even 25%. IBD's William O'Neill advocates an 8% stop. There's no, what I don't like about it is there's no accommodation for the volatility of the stock, okay? So some stocks are volatile and they will move a lot. Some are not volatile, they will not move much. So it doesn't kind of look at that. But it's one of the most commonly used exit strategies. It can also be used as a target. For example, some traders like to take a profit when price hits 20% profit. Okay, boom, automatic, they're out. It works for them, and that's good enough. But I believe there are better ways of exiting. We talked about moving average trailing stops, 30-day, 50-day, 200-day for daily bars. If price falls below, you exit. If you're going long, you can't buy below the moving average. So what happens is if you get stopped out, then you're looking for a re-entry. Well, the moving average, the price doesn't drop below the moving average, so you won't get a re-entry. That's the downside of this. We've talked about crossovers, the golden crossover, or 50 and 200-day period moving averages. Again, it's a bit slow sometimes. And sideways markets generate a lot of whipsaws, which can total to large losses when they're combined. So let's take a look at them. Here we have 30, 50, and 200-day moving averages. So like the 30 days, the yellow one, it's hugging the price. Blue one is 50, and the purple one is the 200. The shorter the moving average is the closer you are to price. This does a nice job of protecting your profits here, and then you're out. But you can't really buy in here when the price is low because it's below your moving average, and you'll have to get back in. And even 30-day moving average doesn't protect you from a big drop. Okay, and if you go to, let's say, 200-day moving average, which a lot of people will look, it'll keep you in the trade a lot longer. But look at all the drawdowns you have to endure and still be in the trade. Okay, that's a problem, and that's exactly what the issue is with moving averages. And if you're looking for a cross between the golden cross between 50 and 200, it never comes. A cross between 30 and 50 comes in here. But I mean, look. Your high was here, and then you're exiting right in here at the open, right on this bar. I mean, that's a substantial drop down. We're talking about dropping from 350 to 200. So percentage-wise, it's almost 50% drop down. Okay, that's huge. So that's the problem with moving average crossovers. Okay, the next exit strategy I'd like to look at is trend line breakouts. And I know this has been mentioned before. For those of us who are not as comfortable or familiar with trend lines, is for short, you connect the recent highs. Again, do not cross on any wicks, okay? You're connecting the swing high wick to another swing high wick. For longs, we're connecting the swing lows, a wick to wick, and you do not cross any wicks. And if there's a breakout, we exit on the other side. There are two different ways people like to execute it. When when price goes below a trend line exit, the people immediately exit there. And some actually like to wait for a close beyond the trend line for added safety, because sometimes you just get a spike and then you're not out. But waiting for a close beyond sometimes may result in worse exits. So it's a compromise. Now, also, if you know which direction to trade, i.e. you've got a good idea about directionality, trendline breakouts are great entry strategies for entries as well, okay? I actually have a whole flow entry strategy based on some of this. So let's see what they look like. If you're short, which is where you would be here, this is how you would draw the trend line. And right in here, see here, we touched it. I'm not sure if it executed, so you could have exited here. If you waited for a bar to close, this would be the close, and you would exit on maybe the open of the next day, and actually this would give you a better exit, okay? This would be for a short. If you were long, and you see the way I draw the trend line, I started from a swing low, and I'm touching another swing low. Here's another one, and here it is. So if you were waiting for a breakout, right in here, the trend line gets penetrated. So this would be a first entry exit. And if you are looking for a breakout of a trend line, a close below the trend line, the first close in here, so you'd be exiting right here, okay? At this case, as it turns out, this is worse than waiting for, waiting for a close below the trend line was worse than exiting when the trend line was penetrated. So it can go both ways. You decide, which one you want to take. They're both equally popular, I think. I have a slight preference for a close below or above the trend line on one strategy. On another strategy, which I'll mention on a swing, low swing high strategy, I get out when they're penetrated. Okay, but they're both equally good. They're both equally respectable. Just an easy way to be able to get out. Okay. Okay. The next one I want to talk about is one of my favorite strategies, exit strategies. It's the swing low trailing stop if you're going long, or swing high trailing stop if you're going short. So I'll talk about the swing low just to make it a little easier, because most people like to trade the long side. So we place a stop below the most recent swing low, okay? Ride the trend and have the market take us out. Unlike a percentage stop or a fixed stop that's established at the beginning of the entry, at the beginning of the trade, what this thing does is it allows you to move your stop as the trade is going up. It allows you to ride the wave. It allows you to ride longer term trades and longer term moves. And when things change, it takes you out. The nice thing about this, it works on all time frames. I have used it from weekly charts to 1 minute bars, okay? It works. 1 minute is very noisy, but 3 minutes and above, it works. 5 minutes, it works great, okay? Now, the advantage of this, as I said, it'll lock in profits, but exit faster on trendless markets. And you can be whipsawed just like any other exit strategy, okay? But this one is a little bit more intelligent, and it tells you, it lets the market tell you, okay, where it's gonna be. So if you were long, for example, here, this is the last swing low. By the way, I define swing lows as the lowest low of the 5 bars below and 2 bars after. So you're not going to know if you have a swing low for at least 2 bars afterwards, okay? And the reason for that is if you're in a down move, the down move can continue. You just don't know where the bottom is until 2 bars later. Some people like to use 3, which delays things. For me, I just use 2. Why 5 and 2? You know, I've been testing and using it, as I said, for over 20 years, and it just works. So here, this is the swing low. The price moves up. It goes down. It makes another swing low. Okay, right here. Its chart is a bit small. I'm on a large screen. Can everybody see it clearly where the white lines are? Oops, sorry. I lost my mouse there a little bit. So here, okay, here we made another swing low, but you notice the swing low is above that one. So we're keeping this one as the new stop. And as long as the price is above it, we're moving fine. Here we make another swing low. This swing low is above the previous one. So this is my new stop. And I know it right on this bar, 2 bars after, okay? And I am continuing with this low as my stop. And we make another upward move, and then we make another swing low. Again, this swing low is higher than this swing low. I know it right after the second bar. I'm a little far away, so it's pretty safe. I move my stop here. I move up there, and boom, there's a big back down bar. Okay, boom, there's another down bar. Am I exiting now? No, because you know, I haven't hit my swing low, and 2 bars later, I make another higher swing low. So this is my stop. I keep that one. Price oscillates and it goes sideways. Sideways is the death of stops, okay? And what happens is here we have another swing low that I put in. Nice, price goes up and then it goes back down. And what happens is the swing low that I had here last got penetrated and I will stop. Okay, so you can either use the penetration or a close below. Either way, it'll take you out around the same place. Okay, and in this trade, it's even nicer. Let's say if you entered here, this is your last swing low. As you make higher swing lows, you move it up, and right on this one, you get stopped out. Okay, and actually, this will stop you out because it penetrated. Okay, if you were looking for a close below the swing low, okay, this would not have taken you out. It would still keep you in the trade, and look what a beautiful move it does, okay? And right in here, you'd either get stopped out here or you'll get stopped out here. Yes, a big drop, but again, I'm including this very rare situation where you have a huge dramatic drop and what happens on a dramatic drop. But anyway, if you have entered incorrectly, either on a breakout right here, or some other strategy, you'd be riding the wave and you'd be enjoying the nice up moves without really having to worry about a huge drop. You know, this is kind of unavoidable. Actually, it is kind of avoidable, but again, there are other more complicated strategies that might indicate. I don't have the volumes, for example, right here. If memory serves me right, there was a huge volume. And any one of you who's using VPA, volume price analysis, will realize that we have a tiny little bar here, probably on a huge volume, showing a huge battle between buyers and sellers. Baby. I'm sorry, what? Did somebody say something? Okay, so there'll be a huge bar where buyers and sellers are fighting, and then an engulfing bar afterwards. This would be a sign of a turnout. So there are ways that you can do some more analysis and get a little bit more protected. Okay, Any questions so far? All right. Again, this one is the lowest low trailing stop. Again, these are slightly different variations. So you take the lowest low instead of a swing low, you take the lowest low of 20 or 30 periods, whatever time frame you're trading, and you subtract half to 1 ATR. Okay, it is not as sensitive as a swing low trailing stop. It does not lock the profits as well, but you don't get stopped out as often either. Okay, so let's see what it looks like. By the way, I'm using the same charts so you can actually see how it affects it. And the white dots are the stops. So, and the arrows shows us when we get stopped. Okay. And yes, initially we get stopped because we're kind of chopping here. On a nicer up moves, we get stopped in here. So we stayed here entire up move. We did not get stopped. Obviously, we did get stopped here. But look at here, a nice big up move. And we got stopped in here. That's definitive stop. Nice up move. And we get stopped in here. Okay. So what the factor for the ATR to use requires a little bit of experimentation. As I said, I find typically half to 1 usually working well, but you need to kind of experiment a little bit to see what's working for the instruments that you're trading. The next one I want to look at is a low band trailing stop. And instead of taking the lowest low, you take the 20 period moving average. But instead of subtracting half to 1 ATR, you subtract 2 or 3 ATRs to create a stop band. Works very similar. And when price hits the stop band, you exit. Okay. And let's see what that looks like. Now, it's not as smooth stops like the previous ones. And as you see, the dots vary all over the place. But one thing you'd notice is you stay in the trade longer. Remember, we had several stops in the past couple of exit strategies. Here, you're exiting on the white arrows. So you get to ride this entire thing through. And here you get to ride this entire thing through without getting stopped. But look what happens. I mean, you're getting stopped here, which is significantly worse than what you were getting stopped before. So, if a dramatic drop doesn't happen and you have the stomach for, bigger drops, you certainly can use this. Just understand that on a big drop, that this is not going to protect you as well. Okay. And one of the things is mathematically, if there's a huge drop, the stops could be above the high of the price, and that's the time to get out. It's you don't even have to wait for a penetration. That by definition is penetration. Mathematically, it can get a little awkward, but as long as you understand it, that's okay. Okay. Again, the advantage of this is it works better in sideways and slow trending markets, but it does not protect you as well. Okay. Support and resistance levels. Okay, you find the recent support and resistance levels, and swing highs and swing lows are pretty good, especially in a higher lever time chart. When price goes below support, you just cut your losses and exit. When price hits your resistance, you can take profit and exit. They are subjective and especially problematic when new highs or new lows are being made because there are no other swing prices to be able to find support and resistance. Fit points above 100% are usually what people use. And also a lost and forgotten art, point and figure charts. They're excellent tools for finding support and resistance. I think that's why one might want to use them today with all the bar charts that we have. I think TradeStation does point and figure charts, and I'll show you what they look like. Okay. So again, this is support and this is resistance. Okay. If price goes below, I would have exit. Price goes to target, if I entered here, I would take the profit. So again, did I lose some money on the table? I absolutely did by taking this profit. And also, by the way, this level above this price becomes resistance. Okay, oh, sorry, it becomes support. So supports can turn into resistances, resistances can turn into supports. So, yeah.
Question: When you said you set the resistance as being your target, are you doing this manually, or are you doing with some automation?
Manually. I always do it manually.
So if you're doing it manually, I have a suggestion.
Yes.
Instead of just putting it as a limit, use a stop loss at the bottom of the previous day's low. Then what ends up happening is that every day, if you're manually tweaking it, just up it up, you would have gained another 20% return on your capital on your gain there.
Oh, that's actually pretty good to know. By the way, I don't recommend this well, actually, I see. So when we break out the what you're saying is when we break the support, watch for a close below or an open below. Sorry. Are we talking about an open below? Is this what you're saying?
I can show you here real quick. Okay, so right here, you exited, right?
Yeah.
Okay, just put
That's,
your
but
stop.
that was a target exit, right?
Yeah, so your target exiting, right? So instead of target exiting, take and move your stop up to here, and then to here, and then to here. And what you end up with.
Yes. But that's a total, that's a trailing stop strategy, which is different than target exit strategy.
Yeah, I know, but I've never seen any case where you try to hit a stop or hit a resistance, and you don't make more money if you just let it go. If you let it go, you almost invariably make money. If you would have hit the where you hit the stop here, then what happens is,
Ken,
or when
if
you
you're
hit the end
drawing
limit.
on Jack's screen, we're not seeing it. We're not seeing
Well,
it.
he's marking with red lines on my screen.
Can you see that?
I got that, but we're not seeing it. You're the only two seeing it, apparently.
Really?
Yeah.
No, I'm
seeing it.
I see it.
I see it.
Yeah, I don't see it either.
Oh,
Me neither.
Steve, why don't you refresh your screen, see if you can.
interesting. That's interesting. So
I can see it.
Can you log
They're
out?
fine little lines. Everybody who doesn't see it, they're really fine.
Yeah, they're very small lines.
I
Can
see.
you
Yeah,
use
okay.
it?
So
Can you
here-
use a different color?
Actually, let me point out, it's here. Can you see it? I'm moving my mouse.
Yeah, we
It's-
can see your mouse.
Yeah,
I see it.
but Ken, this is I'll tell you, it's a different exit strategy, but it's comparing like apples and oranges. You can talk about this as compared to swing lows, which makes sense, which is my preferred exit. I'll tell you one place that's resistance, swing highs are a good place to exit. If you are scalping, for example, the ES, okay? You want to hit a short target, but you don't want to endure a longer, bigger loss. These are perfect. Yes, sometimes price goes above, but what happens is you don't endure the drawdowns on futures trades, which can be pretty expensive. But on a longer term chart, you're right, I don't like taking targets. I like the market taking me out.
got it.
Does that make sense?
Got it.
Okay. So, hey, Steve Alexander, can you see my chart now?
Yes. Yellow
Okay, good.
line and yeah, point and figure. Got it.
All right, I respect your opinion. I didn't want you to miss out on this. So you can give me your feedback. So, how do we get a good idea about where the support and resistance is? That's always been a problem, especially for traders that are not very experienced. So what happens is in TradeStation, you could draw a point and figure chart, this is exactly what it is. And you take this, and what you do is you combine the boxes with as many, you draw a line with touching as many boxes as possible, okay? Right in here, see how many boxes I'm touching. So these are your support and resistance lines. So to me, this is one of the best uses of point and figure chart, which I am really not that experienced in using, I'll be honest with you. But this is one thing I found that's really useful for using point and figure charts. I mean, support and resistance just jumps at you, okay? Can everybody see how easy it is to see where you have a confluence of boxes here, right here especially? It's so clear. Here, it's so clear.
I have a suggestion for you and for everybody else listening. I'm aware that support and resistance is very popular and everybody knows what it means. As a suggestion, I'd say go onto YouTube, search for supply and demand, and search for Sam Seiden, S-E-I-D-E-N, and watch a few YouTubes. He has about, I don't know, maybe 20 YouTube videos about it, and it's far superior to support and resistance.
Okay. Thank you for letting us know. Okay.
So just
Yeah, thank you, Steve. As I said, I mean, I have a book of, I don't know, 300 pages, 400 pages by Chuck LeBeau, only about exit strategies. Okay, there are tons and tons and tons of exit strategies, and if you're interested, you can take a look at them. He and I used to develop trading systems together, and many of his strategies, especially some of the more esoteric ones that are coming up, such as a chandelier strategy, we've used them in professional trading systems. Okay. All right. Parabolic SAR exits. I'll show you what it is. The advantages is it moves very quickly. So if you've got fast moving stocks, it adjusts itself very nicely, very good in locking profits, but eventually gets too close and exits in a long trades, leaves some profit on the table. On whipsaws can cause, just like any other exit strategy, the combined losses could be adding up on sideways markets. And it doesn't provide good stops for early counter trend trades. Okay, so let me show you what it looks like. Again, I'm always using the same chart so you can compare one exit strategy to another. Here is the white dots above and below. The ones below are exits for for longs, and the ones above are exits for shorts. As you can tell, as it's moving up and down, it's changing its direction. Okay, so you get stopped out here where the white arrow is. I'm only doing longs for now. Again, you'd get stopped out here. Don't know where you entered, but and you'd get stopped out here. So that's fairly frequent stops. But if you entered here, you get the rise a little bit, and this is the big red bar is where you get stopped out. One could say maybe it's not such a bad stop, but then, you've left a lot of money on the table because this is just the beginning of a much bigger up move. If you were able to enter again, you get stopped out here. So even if you enter somewhere around here, let's say you get stopped out here, this will be a lossy trade. Then again, it says you probably should not be entering long. Somewhere in here, you entered long. If you entered on a breakout, you'd be entering long here. Look, you're riding the tail, which is great. And right on this bar, Okay, this is for most exit strategies, not all, but most exit strategies. This would be the first bar of exit, okay? And you would be exiting on this bar, okay? So it's actually relatively good in protecting profits or limiting losses, especially when you're trending, okay? So one of the things I should probably mention is, if you've noticed, different stop strategies have different characteristics. You know, some let you stay in the trade longer, get profits more. Some lock you in faster. And depending on where you are within the move, it's a big, long move. You probably want to stay longer. And if you think that the price is getting to be problematic, then you want to exit faster. So nothing says that you cannot start with one exit strategy, but then when you see, you know, such a nice big up move, then you change your exit strategy to a more restrictive one, to one that would lock profits in longer, so you don't miss out. Okay, nothing says that you got to use just one for all. Okay. And then there is slow parabolic versus the fast parabolic. That would let you stay in the trade a little longer. But again, right in here, we exited on this bar for the fast parabolic. On the slow parabolic, we'll be exiting right here. And that's a significant drop on a big move. But on the smaller moves, it would keep us in the trade longer. Okay. So that's a compromise that you make based on what you're trading, you know, what fits your style better. Another thing I looked at is, remember I said with whipsaws you get taken out. Well, what happens if you re-enter when you get taken out? And I just used a very simple, you know, previous swing high breakout. Okay. So, resistance breakout. Let's say we were here, we got out. Right in here, you'll see the blue dots, the cyan dots. They are their breakout entries. So here we entered. We were fine because, you know, parabolic is saying it's protecting the downside. If you entered here, you'd stay in here, and right in here you'd get out. So there'd be a lossy trade. Again, we enter right here. The green arrows point where you enter. So as things change, the breakout entry changes too. So we enter here, okay? Parabolic is supporting us. Look at all this beautiful move that we stay in the slow parabolic, okay? And even if you use the faster parabolic, you will see there are several entries on a nice big up move. That's why the re-entry is so important, okay? Chandelier exit. Okay, chandelier exit is one of the more esoteric ones. It's not as commonly known. So we were one of the exits before is we were taking 20 to 30 period low, moving average low, and then we're subtracting a couple of ATRs. Chandelier works differently. Chandelier, the name comes from the actual chandelier that you hang from a ceiling. We're basically taking a high and we're taking excursions from that high. So if it goes too low, then we're out, okay? Which allows us to stay in trades that are going up, but kind of allows us to exit when things turn around. So let me show you what it looks like. The white dots below the price are chandelier exits. You know, I've written code to calculate that. So here, you know, we take the chandelier high, we'd probably take 3 or 4 ATRs, and ATRs will be adjusted based on the day. Okay, ATR is the average true range, which is really, you know, the bar size, including gaps. So we'd be hanging here. And so as the bar sizes go up, so our stop moves down. So with bigger, more volatile moves, we're protecting ourselves a little bit more, okay? Because we could have been taken out here, but we stay in the trade all the way up here. And if you notice, several of the previous exit strategies would have exited during this range, okay? So this is actually a pretty decent exit strategy that allows to keep you in the trade longer. And if you're in here, if you were able to get in again on a breakout, which probably would have been right around here, look, this is protecting you all the way up, letting you stay in the trade, but you exit again right in here because of the huge drop downs. Okay, you'll have to endure some loss in there. Okay, but as I said, I mean, after seeing such a big, huge up move, okay, you may want to consider tightening the stops a little bit, using to a different stop strategy. Okay. I don't know if I put it in there, but if I haven't, I have one of my favorite quick tight exit strategies, which I'll tell you later. I forgot if I put it in the presentation or not. Okay, I actually haven't, so I'll tell you about it here. It's called the penetration of the lowest low of the last two bars. Okay, so what does that mean? Let's look it up here. This is the low, the next bar low, the lowest low of the last two bars here. When this is taken out, I'm out. But then we go to the next bar. The lowest low, I think, is somewhere around here, which is hard to see. The lowest low is here. When it's taken out, which would be by this bar, then I'm out. Okay, so sorry, for some reason my mouse is getting lost. So this is the bar that I would be taken out, okay, with using the lowest low of the last two bars. So and it's better than being taken out here or here, okay? It's much tighter. Well, yeah, I missed a little bit of an up move here, but I don't mind. It's really, really difficult to be able to predict the highs, the tops, okay? Unless you do some real big volume analysis and figure out you can exit here, again, requires much more sophisticated analysis. And I don't have the volume information here, so I can't do it. It would be very hard to take this as the exit point. But the lowest low of the last two works like a champ if you want a tight exit. Any questions on that? Sorry, I forgot to add it to my presentation. Okay, Bollinger Band exit. So basically you're plotting two standard deviation Bollinger Bands. The price goes above the top band, and this will be a target exit. Price goes above the top band and then reverses, then you would exit, okay? Because sometimes the price goes above and then continues, so I would stay in there. Some people like to exit as soon as you touch the top band. Again, it's a preference. And if you're short, when the price goes below the bottom band and reverses, then you exit. Now, what's also very interesting about Bollinger Bands, which actually John Bollinger, I've known and I've actually lectured with John Bollinger before. And what he says is, when we talk about the exit for a short, this exit would actually be a good one for a long. When price reverses, when price goes down, the bottom Bollinger Bands crosses below and then crosses above, this would be a good entry for a long, okay? And again, price goes above and crosses below, this would be a good entry for a short. So it's interesting that exits can also be entries as well. So I purposely picked a highly trending chart, okay, to see what would happen if you exited on Bollingers. Okay, you notice we don't even get a touch of the low Bollinger Band here. So here we touch, we're going up and up and up, and then we turn and close down below. This would be the exit. Okay. And then here we go up and up and up, and then we close below. This would be the exit. Again, we closed above, we crossed above. Well, depending how you interpret, this could be your exit, or this could be your exit. Okay, so these are not very bad exits, but it takes you out on a longer term a little bit more frequently. Like here, this would be an exit. Okay, we didn't touch here, we taught here, and this would be exit. So those are very respectable exits. Okay. And some of my favorite exits are the swing low, support resistance, trade line breakouts, parabolic. And as I said, you could combine several of the exit strategies based on when you're at. My favorite is longtime favorite is the swing low. It works under most circumstances. And if I wanted to tighten it up, I would probably go after a big long move. One of the things I do is I always look at the 20-period exponential moving average. When it gets really extended from the price, that means mathematically speaking, the following two are mathematical reality. So when price gets really extended from the moving average EMA, either the price will snap back and come back down to the moving average, or the price will hover and chop, stay where it's at, and the moving average will catch up with it. Okay. Now, in very strong, very volatile moves, the price may continue to go up a little further than what it normally would, but mathematically, at some point, the EMA and the price will meet. That's a mathematical reality. So when price gets really extended from a moving average, I would use a more tighter stops, such as the lowest low of a last two bars, or maybe even parabolic saw. Okay. And that concludes my presentation. Anybody has any questions, please unmute and ask.
So Jack, how do you put this all together? I mean, how do you choose?
Well, with lots and lots of experimentation. Okay. So if trading was easy, then we would all be doing it. Okay. As a system designer, there's one thing I'd share with you. Now understand that I used to design trading systems 20 plus years ago that were sold professionally. Okay. And one thing that you know about automated trading systems is they go in phase and they go out of phase. So whatever strategy, and that might take for years and years and years. Okay. And that's why I like high win ratios, because they would have a limited number of max losses. Okay. For example, one of my trading systems had, I think, about a 77% win ratio, and had in a 10-year history, and I like trading, I like testing them on very long-term periods, 10 or 20 years, because it especially if daily charts, because it gives me all sorts of market conditions to see how it's behaving. So it had a maximum of 3 losing trades, and it happened once in 10 years. So first of all, every other, if I had 2 losses in a row, then I would double down, because chances of another loss was big. And one day I got 4 losses. 4 losses in a row, uncharacteristic on the system. I said, this cannot happen. So I traded one more time. I got the 5th loss, and I stopped trading the system. Why? The system got out of phase. And it happens with most automated trading systems. So The point I'm trying to make is whatever you use for exit strategies or entry strategies or whatever strategies that you use, please understand at some point things will change. And whatever that has worked fabulously well for you before may not work anymore. So you need to be adaptive. So you need to understand whatever you do, it's my belief that you have to internalize it. Don't do anything because Jack said so. Do because it resonates with you. Test it, look at it, and see what you believe. Understand how it works, okay? And that's why I'm saying my preference is to go with a swing low stop. And when things get far extended from EMA, I would probably switch over to lower low of the last two stops, of the last two lows. Okay. Now I found that works for me. Ken might say, hey, Jack, you're losing money. You're leaving money on the table. Sometimes I do. Okay. But that's what I feel comfortable with. Ken would feel comfortable with something else. Okay. Ken is using his K stochastics, spent a lot of time on it. It's a beautiful indicator. I'm not looking at it, so he may have additional point of views. Or if you get into VPA, for example, you do some VPA analysis, that might give you some additional data points where you can make your exit strategies, okay? It's all personal.
Right, exactly. Everybody has got to decide and figure out what works for them. Jim's got a comfort level, Steve's got a comfort level, Jack's got a comfort level, I have a comfort level. So you have to figure out what strategy, entries and exits, works for you. Hey, Jack, everyone, are there any questions, comments? I have one little quick one. If you want to see a quick get in, get out. A lot of people talk about, oh, you can only get in one day and get out one day. Let me just show a quick screen here of my my trade station here.
Hey, Ken, I have a question while you're showing your screen. Can you also show us where we at on the 13-day cycle?
On the Jenkins cycle?
Well, last month you present about, every 13 days we're about to, the market pattern about to change. Yeah.
Sure. Yeah. So, all right, I'll do that right after this. Okay, so sorry for going a little bit over, guys, but people talk about, you can only trade and they get in one day, get out another day. Well, I trade even within a day. Because if you could do automation, if you have a piece of automation, or if you don't know how to run all the automation, you can go to Ken.Excess Profits, look at a trade station code, and trade about a price point. So you could basically just say, okay, I'm going to look at the first so many minutes of the day, and if it goes above the, I said 5 minutes, first 5 minutes of the day, I said if it goes above the first 5 minutes, you're going to go long. If it goes below the first 5 minutes, you're going to go short. But this one will also go short and long every bar. So what this one does is it goes long. It went above this high for the day, and it went long 22 shares. Then next bar, it says, oh, I got to go down short. So it turns around, goes short. Oh, it's going long. Okay, I got to go long. Oh, it goes short. And then from that point on, it stays short through the whole day. So I have these small losses, $10 losses, and then you look at through the whole day and it stayed short. So this is Tesla, and it basically takes a first profit target here. So it exited the first profit target, and then it has an exit at the end of the day. I don't want to try to stay with these kind of trades. I don't stay in the trade overnight, but just through the day. So I lost $30 and I made $218. So to me, that's a good trade-off for people that want to minimize the risk factors. This is, as long as you have TradeStation, download the code, give it a try. It doesn't work every time. There are times when it doesn't work. It goes so many trades and then stops. Here's the case on Apple. Apple went through 5 trades and it tried to go short, went long, it tried short, long, straight, long, short, long. It lost $20, and it said, no, forget about it. Just don't trade it. So through that day, it didn't bother trading the rest of the day. So you can enable it at any point during the day you want. Look back so many bars. People don't think about the possibility of trading about a price point. And to me, that makes a lot of sense. It really doesn't cost anything. There's no commissions anymore on these things. So the only thing you're going to have is just a little bit of a loss on the trades that go against you. Usually I can get the trades to go plus and minus, and I can I make a little money, lose a little money, make a little money, lose a little money. This particular one lost three times in a row. But typically, you make a little bit on each of those little trades. So just as an aside there, if anybody has any questions.
Yeah, you said get this at TradeStation. Specifically, what am I looking for at TradeStation? I didn't hear the name of what this is called.
Price point. Trade about a price point.
Okay.
Hey, Ken?
Yeah.
This is Jack. Quick question for you. Usually we refer to IB range or initial balance range, which is the first 1 hour. And then if you you take the high and the low the first hour, and then you go on a breakout, either above the IB high or IB low, or you go short on the IB low.
The strategy will do it. It'll do all that. It'll do all that.
No. But have you looked at it and compared it instead of just looking at the 5 minutes?
I've optimized it.
So this is better than IB. Okay.
You could optimize the hell out of it, and you can go back, years or whatever you want, and just optimize it however you want. However many minutes, the first few minutes of the day, you want to start at this time, end at that time, any way you want to do it. It gives you all the freedom if you understand how to run TradeStation. You understand TradeStation?
Yes.
Okay,
Yeah, of
great.
course.
Yeah.
What was the name of the indicator again?
Price point.
Price point.
Yeah. Trading about a price point. So I hate. It's on Ken.Excess Profits.
Oh, thank you.
Yeah. All right. And then another question was about the cycles. So there is one of the cycles is the Jenkins cycle. And so what we had, I don't know if people can see this. Let me zoom in a little bit here. So it actually did pretty good at predicting the low. It went 2 cycles down, and now it's gone 2 cycles up. And Friday was the end of the Jenkins cycle here. So Monday, is it going to be up, or is it going to go down, or is it going to go sideways? I don't know, but there's going to be a change on Monday.
Oh, Ken, just one more addition on the cycles. A friend of mine follows the moon cycles.
Yeah.
Surprisingly, Friday was also a moon cycle high. So, and typically you would get either a swing high or a swing low within 2 days of the cycle. So Thursday was the low for the S&P 500.
So here is the moon cycle here. And so there is 14 days left to the cycle for the full moon. So you're right, that absolutely, that was the 14th day, which is the
new moon.
New moon.
Yeah.
Yep. Okay, and then was there another cycle that somebody asked about? Did somebody else ask another one?
Yes, this is Brian. You talk about the 13 days, like every 13 days.
Oh yeah, got it. Yeah, so there's the rule of 13. And so here was the rule of 13 going up, rule of 13 going up, rule of 13 going up, rule of 13 going up. So the cyan dots were the start of the 13-day cycle. The red dots were the end of the 13-day cycle. And right now we are in count 1 of a count up cycle. So it's basically reset. This chop here just basically reset the whole thing. So there's no.
So how do you count them? How do you count them? Just 13 days? Or 13
so 13 days, 13 days up is higher. You got either a higher low, higher high, or a higher close. And that's considered an update. And you just count them. 1, 2, 3, 4 through 13. And that basically shows you when the momentum is going to run out. It goes up as well as down, right? So if you, actually, that's not going to work there. That was a futures contract. But yeah, it works the same thing on the way down. So we're in a new futures cycle, so I can't really show you that on that chart. Any other, let's see. Okay. All right. So, somebody that's money flow was asking about, yeah. So let me give you a money flow. Money is flowing out of almost everything except for the transportation and basic materials. Those things are cranking up. Come on. Oh, I gotta exit this is weird. I have to exit the stop share and I gotta go back in real quick. Somehow or other. I'll go back and share it here again. Trade station, okay. Okay, so this is the money flow, and this is the S&P 500. Money has been flowing out of there. It's been just dribbling up. The small cap money has been flowing out. The Dow money is flowing out, and the NASDAQ is the only thing that has money flowing in. So I've been actually trading the NASDAQ, but Friday I was tagged out on the stop. The financials have basically been going sideways, and TLT is going sideways, and China was going up until recently. Now it just sort of pitched down. But the materials here and the transportation are all still on the uptrend. So if you, so what I ended up doing this past week is I sold a put on FedEx. So if you are so inclined, you may want to consider other stocks that are, for example, FedEx here. And what you see is, what I like to see is correlation. Is you see the nice trend on FedEx going up. This is on 30-minute bars. And you see the money flow going into FedEx. That's my kind of company. If I'm gonna trade or sell puts or anything on one company, that's the kind of strategy, or that's the kind of price pattern that I like to see. FCX is also pretty good. And one of the guys in our group did FCX this past month, and so he was ecstatic. He was able to get back in with the 3 green arrows back here, and he's ridden it all the way up to here now. So, and we have 3 green arrows here again, which basically says to get back into FCX. It's copper, it's mining. So it's a materials company. So anyway, any other quick questions? I was going to close this down. We're 15 minutes over time, people.
Time doesn't matter, Ken, when we're having fun.
I hear you. I hear you. So did you learn exit to the left, or exit stage right, or exit stage left?
Hey, sorry, Ken, I did have one more question for you. You mentioned in the last meeting about your election trade. Do you still have one planned? I
have it on. Per Jack's recommendation from the previous meeting, I put on a call. I didn't do a call. I didn't do a spread. Looking at the return on capital, the return on capital is actually better with just this plain old call. So I bought a call on the VIX, 45 call on the VIX, and right now it's actually lost 50%. But I'm hoping I'll probably buy another call on it on Monday to average down a little bit, anticipating that we'll see some sort of a pop. And hopefully people have seen the email I sent out on Larry Williams and his analysis of the election / pre-election. And he shows the results of the, or past history of how it basically falls before the election, and then right after the election, depending upon who wins, it goes up or goes down. Any other comments, questions? Excellent. Okay, well, I hope everybody enjoyed this. I have recorded it. Jack did want me to record his section last time, but so I had to edit it out. But I'm hoping that people will positively respond to me to say that, yeah, the recording is good, and I can share it with the group, because there was a lot of really good information going by here, and I'm sure you didn't catch it all the first time. I know when I go back through and edit these videos that it makes a lot more sense the second time around, and I actually see them more than I want, because when I have to edit them and try to edit out some of the uhs and stuff that I produce and stuff, I try to I'll watch it many, many, many times. It takes many hours of editing. So anyway, good talking to you. Good seeing you guys all.
You can.
Same here.
Thanks. Bye.
All right.
Thanks,
Bye-bye,
bye.
guys.
Thanks, everybody.